Hey there. Would you rather save 12K a year on healthcare premiums today or avoid six figures in taxes later? That's the exact dilemma early retirees face when it comes to Roth conversions and ACA subsidies. Today, we're going to get into one of the trickiest trade offs in early retirement planning: Roth conversions versus ACA subsidies. Because the same move that can save you in taxes down the road could cost you thousands of dollars a year in health insurance premiums right now. Now, on the surface, Roth conversions look like a slam dunk. Roth accounts have no required minimum distributions, so the more you convert, the more you reduce or even eliminate required minimum distributions or RMDs later. Just keep in mind, if you still have money in traditional pre tax accounts, you'll still face RMDs on those balances starting at age 73 or 75 if you were born in 1960 or later. Roths give you tax free withdrawals for life and flexibility in retirement and even estate planning benefits for your heirs. So here's how it works: you take money from your traditional IRA or 401k, pay tax on it now, and move it into a Roth IRA. But keep in mind that if you're younger than 59 and a half, each conversion has its own 5-year clock. If you withdraw converted principal within 5 years, you'll generally owe a 10% early distribution penalty, and earnings have their own rules as well. Once it's in the Roth, though, future growth is completely tax free, and qualified withdrawals are tax free to you and generally tax free to heirs once the 5-year clock is satisfied. Though most non spouse heirs must empty the account within 10 years under the Secure Act. And that payoff can be massive. If you convert, say, 50K a year for 5 years, you might reduce your required minimum distributions later by hundreds of thousands of dollars. That could save you tens of thousands, even six figures in lifetime taxes. Sounds great, right? But here's the catch: ACA subsidies, those premium tax credits that make health insurance more affordable before Medicare, are all based on one number, your modified adjusted gross income, or MAGI. And remember, for ACA purposes, MAGI isn't reduced by the standard deduction. It starts with your adjusted gross income. Then a few items get added back, like tax exempt interest and non taxable Social Security benefits. And Roth conversions count as income. Every dollar you convert raises your MAGI. Raise it too much, and your health insurance premiums can skyrocket. It's not unusual for early retirees to save thousands in ACA subsidies by keeping income in the sweet spot. So if you convert too much to a Roth, those subsidies disappear. And remember, it's not just Roth conversions that count towards MAGI. Capital gains, dividends, interest, and even Social Security benefits, if you claim them early, can all push up your MAGI for ACA purposes. That's why it's critical to consider your whole income picture, not just your conversions. Let me show you with an example. We've got Brad and Maria, both 58, with 1 million in a traditional 401k. They need health insurance for the 7 years before Medicare at 65. And remember, ACA premiums vary widely by state, region, and the plan you choose. So the numbers I'm using here are just for illustration. Your actual premiums may be higher or lower. In scenario A, they keep their MAGI low, around 40K, by drawing most from their taxable brokerage and maybe some Roth savings. In their area, the full unsubsidized cost of the plan they choose for a couple their age is about $1,500 a month. But with subsidies, they only pay about $300 a month out of pocket, roughly $3,600 a year, or about $25,200 total over 7 years. In scenario B, they decide to do 50K Roth conversions each year. That pushes their MAGI much higher. Their cost jumps to the full $1,500 a month premium, about $18K a year. Over 7 years, it's about $126K total in premiums. So compared to scenario A, that's roughly $101K more out of pocket for healthcare before Medicare. Now, ACA premiums will almost certainly rise over the next 7 years, but to keep the math simple, and because we can't know exactly how much they'll increase, this example assumes flat premiums in both scenarios. And that's fine for illustration purposes, because if premiums rise, they'll rise in both scenario A and scenario B. For context, in 2025, the federal poverty level for a household of two is $21,150, so 400% of FPL is $84,600. For reference, that $84,600 threshold is for the 48 contiguous states in DC. Alaska and Hawaii have higher FPL levels. But if the enhanced subsidies expire at the end of 2025, and they most likely will, going even $1 above that 400% line could eliminate subsidies completely. So here's the trade off. Brad and Maria might save $150K in lifetime taxes by converting now, but in exchange, they could pay about $100K more in healthcare premiums in the near term years before Medicare. That's the real tension. Significant long term tax benefits versus very real short term cash outflows. And this is why I always encourage using the healthcare.gov estimator or another current ACA premium calculator for your own zip code and situation, because exact subsidy amounts and premiums will vary. I've included a link to healthcare.gov's estimator in the description. The good news, though, is this doesn't have to be an either or choice. You do have some options. For example, you could do partial Roth conversions. Some retirees aim to convert just enough each year to avoid losing all subsidies, keeping income under 400% of FPL so they don't go over the subsidy cliff that we'll likely have in 2026, assuming the enhanced subsidies expire. This gives you some tax flexibility without blowing up ACA savings. But here's a critical warning. If your income ends up higher than you estimated, for example, from a larger than planned Roth conversion, you could lose subsidies entirely and have to repay them at tax time. Also, you can consider alternative coverage paths. If ACA premiums climb steeply after 2025, another option is to forget ACA altogether. Some people may find a better deal with private health insurance or consider health sharing ministries, but you need to be aware of the risks with these alternative coverage paths. I've covered all the options for health insurance in early retirement and their pros and cons in another video, which I'll link in the description. Another thing to keep in mind, once you hit 65, ACA subsidies no longer matter. That's when you can push harder on conversions. However, keep in mind that large conversions after 65 can raise Medicare Part B and D premiums 2 years later due to income-related monthly amount or IRMA surcharges and their 2-year look-back period. IRMA is Medicare premium surcharges when you have high reported income. And remember, if you retire really early, say at 55 or younger, you actually have a long runway to spread out Roth conversions before RMDs start. That means you don't necessarily have to rush conversions right away and give up subsidies in your 50s. Even if you wait until 65, you could still have 10 years to chip away at those pre-tax balances before RMDs begin. Of course, whether that's enough time depends on how big your balances are and how much you can convert each year without bumping yourself into higher tax brackets. So, how do you decide what's more important? Think about 3 things. First, how valuable are ACA subsidies to you right now? If you're retired in your 50s or early 60s, those subsidies can easily be worth tens of thousands a year. If you qualify, protecting them might outweigh the benefit of doing large Roth conversions today. Second, what do your RMDs look like if you don't convert? Look ahead. If your 401k or IRA balance is big, those mandatory withdrawals in your 70s could push you into a higher tax bracket and increase your Medicare premiums due to IRMA. That's where spreading out smaller conversions earlier may pay off. Third, what if the enhanced subsidies really do expire at the end of 2025? Well, if they do, and they most likely will, if your income is already above 400% of the federal poverty level, you're not getting the subsidies anyway. So there's no longer conflict with giving up subsidies in exchange for doing Roth conversions. And here's one more wrinkle. Under the current tax law, thanks to the One Big Beautiful Bill Act and its extension of the 2017 tax cuts, today's lower tax brackets are locked in for now. That means if you're already over the subsidy cliff, it could make sense to accelerate Roth conversions while those favorable rates are in place. Future administrations could change the tax brackets or rules, so the political timing is part of the equation too. So here's the bottom line. Roth conversions and ACA subsidies are both incredibly valuable tools, but they work against each other. The smartest early retirees don't necessarily choose one or the other. They balance both based on income thresholds today and on the likelihood that we'll no longer have enhanced subsidies in 2026. And for some, the smartest move may be to stop chasing subsidies altogether and focus on other healthcare options while securing long-term tax freedom with Roth conversions. I'm sure this video has given you a lot to think about, and the truth is, deciding if and when to do Roth conversions takes careful planning. If you'd like to start modeling different Roth conversion strategies yourself, I personally use Bolden's Retirement Planner. It's an invaluable and powerful retirement tool. You can try it out for free, but to unlock their Roth Conversion Explorer along with other advanced features, you'll need the paid plan. If you're serious about exploring conversions and not only that, seriously locking down your retirement plan, I highly recommend it. Take the time to check it out. There's a link in the description. That said, these decisions can have big long term tax and healthcare implications. So, in addition to using tools like Bolden to do your own exploring, you may also want to consult with a tax professional and perhaps a certified financial planner or CFP to make sure your Roth strategy fits your overall retirement plan. I hope this video gave you a lot to think about and helped you. If this video gave you a new perspective, hit like and subscribe. And I'd love to hear from you. Are you prioritizing Roth conversions, ACA subsidies, or preparing for 2026 and the likely loss of the enhanced subsidies? Drop a comment below. And make sure to download my free checklist 12 must do steps to retire sooner and smarter. And if you want to see exactly how different income levels change ACA premiums, watch my video on real ACA scenarios. It's right here, as well as the video on alternative health insurance options, in addition to the ACA and early retirement. Thanks for watching. And when you're on the go, Early Retirement Roadmap is also available as a podcast wherever you get your podcasts. And go to mikeupland.com for all my media, including my blog. Until next time, this is Mike Upland, early retiree at age 55. Take care and make the most of today.